County, we ever had a terrific breakfast in February. Blake Parrott and Minsky professor Ty Coleman talked to us about her ideas for teaching underprivileged children. If you weren't here, and I know most of you won't, if you weren't, because it was kind of a small February crowd, but it was fantastic. It's on YouTube, as are all of our breakfast speakers, so I encourage you to go there and hear Ty talk from last month. And next month, we'll have Doug Gayton with us. He will be here as part of the Philip Otis Environmental Authors Program. Doug is an artist, filmmaker, writer, photographer, and author of the book Local, New Face of Food and Farming in America. So after spring break, I hope you come back and join us for the breakfast as well. Well, as you know, Blake is committed to 5 core values: respect, love of learning, integrity, courage, and a commitment to pluralism. And I can't think of any more concrete example of the Blake community walking the walk in regard to pluralism and diversity than inviting a graduate of SPA to talk to us. Andy Redleaf has seen the light, however, and has enrolled 2 of his daughters here at Blake. Isabel graduated in 2013, and Ellie is a junior this year. After SPA, Andy attended Yale University, where he graduated in 3 years with both a bachelor's and master's degree in mathematics. Typical SPA style. Andy has worked in New York, traded options in Chicago, then returned to Minneapolis, where he founded Deep Haven Capital Management, and then Whitebox Advisors. Now, I owe all of you an apology because I should have invited Andy to speak here 10 years ago. Had I done so, and had we heeded his warnings, all of our investment portfolios probably would have performed a little better during the Great Recession. That's because Andy saw it coming. In a December 2006 letter to his investors, Andy wrote this about mortgage-backed securities that would bring the economy to its knees. Sometime in the next 12 to 18 months, there is going to be a panic in the credit markets. The driver in the credit market panic of 2007 or 2008 will be a sudden, profound, and pervasive loss of faith in the alchemy of structured finance as currently practiced. Well, you got that one right, Andy. And looking back at the crisis, Redleaf opens his book, Panic, with these pointed words, which I find particularly interesting amidst all of the rhetoric in today's current political campaign environment. And I quote, "Because the financial crash of 2008, like the crash of 2029, followed a powerful prosperity, it is often described as a crisis of capitalism, as if prosperity is self-destructive. This is a primitive delusion, like believing drought and hailstorms are divine punishment on the inventors of crop rotation. The crash of 2008 was driven by a betrayal of the most fundamental principles of capitalism, both in Washington and on Wall Street, by those often imagined to be capitalism's champions. The crash came not because we had too many regulators, nor too few, nor even because the regulators were incompetent. The crash came because both the regulators and the major players believed in the same bad ideas." The book goes on to describe the origination and consequences of those bad ideas. But here to share with us some good ideas and to help us understand what the markets are telling us today is Andy Redleaf.
Because I don't want to get you sick.
Well, thank you. I can assure you I get lots of things wrong too, though I try not to point them out too prominently. So I'm going to start a little bit with how we think about investing generally, and then move on to sort of some things I see now. I actually, Whitebox, we have 10 investment principles, which we take very seriously. I printed out 100 copies, which are sitting at that table. You're free to take them or pass. I didn't pass them around, whatever. We have them, engraved on our main conference room. We give them to everybody who walks in, so they're not secret. They're not privileged. They're not even sort of a secret sauce. And I'll talk about a few of them. First and most important is that we believe that the source of return is the efficient reduction of risk. You've all sort of heard sort of no risk, no reward. And if you talk to a financial advisor, they'll say, well, how much risk are you willing to tolerate? And the more risk you're willing to take, the more reward we can get you. I think that's 100% wrong. If I'm being provocative, I will say in the history of the planet, I do not believe that anybody has ever been paid for taking risk. So I made that statement 4 or 5 years ago at one of Professor Schiller's classes at Yale. I was speaking there. And Professor Schiller said, well, what about insurance companies? And I said, great chance to win an argument with a Nobel laureate. I said, proves my point. What an insurance company does is uses the law of large numbers to take individual idiosyncratic risk, get it at a systemic level where the law of large numbers plays out, and if an insurance company is taking risk, they're making a mistake. And sort of insurance companies with bad actuaries, over time will do less well than insurance companies with good actuaries. In the book, we talk about the career of Henry Ford and how at no stage in his success is there anything that looks like taking risk. And I think you could say the same thing. Think about Bill Gates or Mark Zuckerberg. Any one of the great successes, and nothing they do, nothing they've done actually looks, feels, or really relates to risk-taking. For those of you, if you run a business or you serve on a board or what have you, I don't think, you might occasionally say, well, should we be less timid or something? But the bulk of what you do is, all right, here's what we want to accomplish. Here are the things that can go wrong. Here's sort of the things we have to overcome. And we want to direct most of our energy to the extent we can to mitigate those things, to work around those things, to lessen them, to in fact efficiently reduce the risk or the chance of things going wrong. So that's the first and most important thing, is that the efficient always looking for the efficient reduction of risk. Second thing, I'm going to talk about 3 of them. The second one, I would say, is we try and focus one level below the obvious, which is what I hope some of my remarks today strike you as sort of one level below the obvious. And what one level below the obvious, there's no absolute definition of that, and you can't say, oh no, that's no good. That's 2.2 levels below the obvious. But the point about one level below the obvious is it should sort of strike you, I haven't heard that before, or haven't heard that a lot, but gosh, that makes sense. Or I can't believe I hadn't thought of that before. I think that the source of return comes from the efficient reduction of risk is just that kind of statement. It's one level below the obvious, but if you actually look, and if you can actually look at sort of data, and it makes great sense. The thing about something is 5 levels below the obvious, it will never get recognized, and it will never get repriced, and so forth. And if it's absolutely obvious, there's a much better chance that in fact it's already efficiently priced. So we like things that are kind of neat, not exactly obvious, but that can make sense to somebody without any advanced training in math or physics or economics or or anything. And third thing I would mention is one of our principles is that the market has a message, and listen to the market. The market can be wrong, but before you want to assert that it's wrong, you want to understand what it's saying. It's just as if you were having a conversation with somebody. First and most important thing is to actually hear what they're saying. What is it that they believe? What is the point that they're trying to make? And you can't agree or disagree until you sort of understand what it is that it's saying. And I think this is actually a somewhat unusual notion. There are more commonly kind of two schools. There's Warren Buffett quotes his teacher Ben Graham a lot, saying think of the market as a seriously deranged manic depressive, and a lunatic, and ignore it. It's all noise. It will lead you down the wrong path, and that's kind of one school. And the other school is sort of the Chicago school, as it were, the efficient market school. That the market is so omniscient, all-knowing, efficient, etc. To have a conversation with it, as it were, to disagree with it is just pointless, and even to try and understand what it's saying, is unnecessary. Just sort of be in the market, and you'll get market returns, and that's the best you can do. We believe the market does make frequent mistakes. It gets things wrong, but almost all the time it's saying something that a coherent, sane person could believe. And before you can disagree with that, you want to divine what it is exactly that it's saying. So I'll turn to that now. What I think, kind of listening to the markets, what messages are there. First, and most decisive, for a year plus, the overwhelming majority of markets have been saying that the global economy is extraordinarily weak. Not just sort of garden mill recession, slow, Goldilocks, slow growth, new normal weak, but extraordinarily weak. So that's commodity markets, oil in particular, down, all of them down between 25 and 80%. Fixed income markets, both kind of riskless interest rates, at extraordinarily low levels, and risk kind of spreads, the difference between kind of high yield and perceived riskless spreads widening over an extended period of time. So most markets have said the global economy is extremely weak. The sort of one exception is kind of large cap U.S. stocks, a handful of glamour names and so forth. And even there, the message might be weak underlying economy. It's just sort of special companies that aren't subject to the vagaries of the economic winds that have been doing well. Coupled with that, one of the things I think is really interesting in the last few months, strongest market and strongest asset class since the first of the year is gold, up 20-ish kind of percent in 6 weeks. At the same time, the things where there has been inflation over the last couple years, which are really sort of capital flight, have topped. High-end apartments in New York, around the world, they're topping out. They're weak. Contemporary art, the various art markets that have doubled or tripled, all of those sort of things above their previous pre-crisis highs. And one of the messages I would take is, there's sort of no reported inflation, but there's been inflation in certain rich people, capital flight kinds of goods, sort of high-end New York apartments, contemporary art, and so forth. And I would tentatively posit the hypothesis that the markets are sort of saying, capital flight to the U.S. may well be over, and inflation might be moving from rich people inflation to more broadly based kind of inflation, and also that I wouldn't want to bet on the U.S. being a beneficiary of capital flight in the next crisis. Lastly, I would kind of point out that many markets are the least liquid any of us have ever seen. Sort of less than even in kind of the crises period. One sort of example is Sprint debt. Sprint, the cell phone, the wireless provider, bellwether high yield issuer, several $billion of debt. Their kind of bonds went from little over par, 102, 103 in, say, July, to the low 90s towards the end of the year, then gapped down in January, early part of February, to the low 60s, and now back to the mid 80s on maybe 25, 50 million, at the most 100 million bonds changing hands. So the markets are extraordinarily illiquid, and one has to sort of take that seriously into account. And that's, sort of market illiquidity is an explanation for one phenomena that might appear bizarre otherwise. Now, generally speaking, bank debt, which tends to be the very top of companies' capital structures, the first sort of securities to get paid, across the board, bank debt yields slightly more than high yield bonds, which are almost always below them in the capital structure. And this, sort of on a kind of held to maturity basis, this would be a pure arbitrage. You can own something that gets paid first, sell something that gets paid second, and collect a little bit while you wait. Sort of, you might say, kind of a pure inefficiency. But listening to the market, how could a coherent, sane person believe that? And I would throw it out that the market is suggesting that there's a decent chance of a liquidity kind of squall, crisis, what have you, in the loan market, which makes lots of sense. They're now sort of mutual funds that own bank loans. They offer daily liquidity. Loans take between 2 and 4 weeks to settle. Dealers are out of the markets, et cetera. It is easy to envision a sudden, complete loss of liquidity and sort of a dramatic, though temporary, price drop in that asset class. So you put, all of this together, and I think it's a time for great caution. One statement again, I think is sort of one level below the obvious. I'm guessing most of you came here to hear about the stock market. And if you're talking to a financial person, you expect them to talk about stocks. Stocks are one of the things that I find really, really interesting is everybody here can almost certainly name some famous stock pickers, whether it's Warren Buffett, Peter Lynch, dating myself in terms of age, Muriel Gabelli. You read Barron's, the round table is always stock pickers. I think there aren't, you probably cannot name any bond pickers. You've heard of Bill Gross, maybe you've heard of Jeff Gundlach. They're interest rate forecasters. They're not sort of individual bond pickers. But bond picking is actually quite a bit easier than stock picking. And if you look at back in the pre-crisis days when the investment banks managed active books, traded their own accounts, were trading with their own money, what did they do? They didn't have big equity books. They had fixed income books, gold, fixed income commodities and currencies. That's what sort of smart people in the markets every day did with their money. And I think there are some interesting kinds of anomalies that work very well in an environment where I think one wants to be extraordinarily careful. So I actually, I want to trademark, so maybe I shouldn't say it out loud, I haven't done it yet, but I want to trademark SHY investment strategy, SHY, which an acronym for safe high yield. Where does one find this? How does one think about it? Well, for an individual, it is very hard to trade the fixed income markets. But you can think about three pieces that go into determining whether a bond is a good idea or a bad idea. First piece is what I would call valuation. How much interest are you getting relative to sort of three things, relative to how much debt the company has compared to its equity, so yield relative to debt to cap. Second is yield relative to their earnings or an adjusted earnings, how many times can they cover their interest, et cetera. And the third is yield relative to the volatility of their cash flows. Are they steady or not? So first thing is valuation. Second thing I would say is kind of the quality of the business. Is it good business or bad business? Is it growing or shrinking? Do they have above or below average profit margins? And the third thing I would suggest, probably the most important thing, is and the thing that is maybe obvious, but I would assert one level below the obvious, is behavioral. If a company is a double B credit, if a company is sort of just below investment grade, That's very likely to be a policy decision. It's a decision of company management that they want to be a double B company, that's the way they want to arrange their capital. It may be a good decision, it may be a bad decision, but it's largely, not entirely, but largely within the company's control. So, a company that says it wants to be investment grade has a good chance of being investment grade. Now, not that many companies say that explicitly in their earnings releases or in their public filings. Companies don't like to say a lot of things explicitly, but there are sort of certain clues. Does management and the board come from the investment grade world or the levered world? When the last time a company refinanced debt, if they had a $300 million debt issue coming due, did they replace it with $250 million of debt and $50 million of cash on hand, or did they sell a $350 million debt issue because they could? You can kind of divine clues from the way companies have acted, and sometimes it's actually specific. So I throw out, Yum Brands, which is Kentucky Fried Chicken and Taco Bell. They've said very, very explicitly that they want to return $6.2 billion to shareholders over the next year, and they want to maintain debt at 5 times EBITDA. So they want their debt to be, sort of 5 times their cash flow. So you can look at that, and there is zero chance until they change their mind that Yum would go back to being an investment grade company. So that's so what we've been spending our time lately doing is looking for sort of highish yielding bonds that are priced in sort of the average, that on a valuation basis are at least reasonable, kind of in the middle, but have sort of better than average businesses and better than average behavior. And when we sort of back test this and look at it, it looks like that sort of portfolio does 100 basis points better than the double B market as a whole, and it does it with about 60% of the volatility and 60% of the drawdowns, and in most sort of kind of measures, 60% of what just buying the bulk of the high yield market would do. So again, an illustration that the source of return is the efficient reduction of risk. So with that, I will conclude my semi-prepared remarks and work on ducking any questions I can't answer.
Andy, would you offer a few comments on the state of the world economy versus the United States, and sort of the media seems to be portraying as a semi-global slowdown rate?
Well, as I did comment, so most markets are saying that the global economy is very weak. I'm not sure, and I don't try and predict the economy. Certainly, if it's not, there are lots of things that are cheap. I suspect if we avoid a trade war, which I think is a big if, and global trade has been declining, both as maybe as a measure of economic weakness, but maybe as an indication of nascent sort of mercantilism. If we avoided trade war, I think the economy will be okay. There actually was, I found it interesting. I believe it was yesterday's Wall Street Journal, the kind of op-op, the third editorial page on could Trump unilaterally start a trade war, and the point of the piece was that he could. There are lots of sort of places that would give him authority. So yeah. So I'm sorry. So the question was. Oh, so the question is kind of where would capital flow in a general sort of loss of confidence, and the simple answer is I have no idea, and one of the things about this period of time that's a little different is the exceptional monetary policy we've had all around the world. Sort of trillions and trillions of dollars of debt trading with negative yields, which we would have thought was impossible. Massive amounts of excess bank reserves in the United States, which we also would have thought was impossible. Sort of most of the time you've seen sort of monetary regimes and economic stuff that, well, this is a little bit different than what happened 10 years ago, but it rhymes. In this case, I don't think there is no one alive who has sort of any kind of base of experience to draw analogies to what the unwinding of the current monetary regime or a loss in faith in central bankers, exactly what that looks like and how it plays out. So I have no idea. I would say, the favorite thing on the Whitebox books. We own two gold mines that we acquired through their debt and restructuring. Approximately $30 million invested in two assets. Together, sold for about $3 billion when gold was $1,500 an ounce. So I think that's my single favorite thing, but I don't have any idea.
Andy, if you've got a primary all-weather investment vehicle, could you describe the asset allocation framework: cash, stocks, bonds, long, short, overweight, underweight?
I actually once coined the term, or tried to coin a term, radical conservative asset allocation, by which radical in the sense that I don't believe in kind of 60-40 sorts of things, that you should always have some stocks, some bonds, et cetera. Conservative in the sense that one needs sort of a good reason to own something. So I think long-dated sovereign debt, the single worst thing. I do think at some point people will scratch their heads and say, what were we thinking? Owning 10-year bonds at 0 in Germany, or 5 bips somewhere, 150 bips here. So I think people should have 0, long dated sovereign debt. I'm not. I used to consider it morally repugnant to own gold. I think, actually everybody should now own a little bit of gold, or some gold mining shares. I think, actually, what I've called safe high yield, double B credits with better than average businesses, and at least the appearance of bondholder friendly managements. I would weight that.
What are some of those?
One local company that's kind of interesting is Deluxe Check, which actually kind of a classic example. So they have a business that's going away, paper checks, and they have a collection of new businesses which are actually growing at about the rate that their check business is shrinking. Conservative kind of bondholder friendly management, that came up in a screen. Foot Locker is another company, came up in the screen. CEO is ex Home Depot, company that never levered up. They are returning money to shareholders, but they're kind of they're making sort of sensible. They have I think they have really a policy of half of cash flow going to shareholders, half of it going to reasonable capex, and their debts been really steady. A number of other companies have come up on some screens. And NCR came up on one screen. It is really, again, markets are really illiquid, and you pay a real sort of spread to be an odd lot. So it's hard for individuals to do. The one I said, people in the audience wouldn't be able to name a bond picker. I can name one, Dan Fuss. Maybe some of you have heard of him. Runs high yield at Loomis Sales. I think the Loomis Sales high yield fund might approximate that concept. Roger.
Assuming that climate change is very real and that it's probably the most important thing going on in the world, and that's an assumption, how does that affect the overall long-term investing financial picture situation? I don't think much. I can be called a, and this is, again, sort of well beyond my expertise, but I believe that the Earth's climate is inherently stable. That the case for global warming is, we're burning fossil fuels. We're emitting carbon dioxide. Carbon dioxide is a greenhouse gas, trapping heat, which will increase evaporation from the oceans, increase the concentration of water vapor, which is the primary greenhouse gas
and you have a self-reinforcing cycle. I think we don't really understand whether, but I feel highly confident that negative feedback loops dominate positive feedback loops. That in point of fact, whatever they are, cloud formation, how that relates, and so forth. If positive feedback loops dominate, the Earth would have burned up, millions of years ago. And if you look back over time, climate fluctuates, but it does it in a pretty narrow range. And so I don't worry about it. And I don't, I actually think there's directly anything one could do. I do think, one of the features of our markets over the last bunch of years is they are more politically dominated. And, in general, it's been okay. It's been better to be on the side of government than on on the side of the industries government doesn't like. So would give me pause, in investing, over a very long term in fossil. I think you can say that people involved in touching sort of fossil fuels have a below average business over the course of time. I mean, fossil fuels are kind of the smoking of our generation. That said, it's very long term, and I wouldn't base intermediate term decisions on it.
I think time for one last question.
Andy, you mentioned that part of your screen is looking at companies that would have positive fundamentals as you or have management that's always doing the right thing. Are there any industry groups that have surfaced more than others as places you would like to be, or general themes, areas of investment, whether it be water, data security, or anything along those lines?
On the behavioral side, nothing that pops out or comes to mind. They're sort of spread pretty randomly. On the business side, we do actually try and compare businesses within their industry and weight that more heavily than industry kind of bets. So, are your profit margins better than average for your industry code? Offhand, I'd say no. It's not, not in the realm of what I've talked about, but there are some serious anomalies in the energy space. Particularly, there are a number of stocks, sort of $1 to $3 stocks that have essentially zero chance of making it. So there's a dollar stock, $150 million equity cap. They have sub-debt trading at an eighth. So that has to go up 800-fold if you believe in strict priority before stockholders could get paid. So there are a lot of zombie energy stocks.
Andy, in the world of ETFs and the Labor Department fiduciary rules, you talk in your book about diversity and the fact that this idea of diversity has gotten so broad and everyone is following, they're diversifying exactly the same. And so there's also these coincident factors that could happen. Is that leading to volatility that you're concerned about, or are there opportunities to take advantage of that?
Well, it's part of the illiquidity picture. that's really, really tricky because it's even kind of day to day. In the bond market, you have to be there and see a seller when there's a seller. If if he's gone the next day, they're not going to trade. And I think the world is more connected. The world is more correlated. Part of it is the world is more political. If in fact there's sort of a serious trade war, it's hard to see exactly what would benefit in owning domestic stocks, international stocks. But it will all be bad. And I am sort of against the idea that one should own 10-year government bonds yielding 0 because you have to own some 10-year government bonds to be diversified. It makes no sense to me.
Well, Andy, if you can stick around and answer questions after we break up, that would be terrific. But in the meantime, I want to thank you ever so much for joining us today and for your remarks. It was really great. Thank you. Hang on.